What is going on, traders? So let's take a look at the Fed's balance sheet. This is going to be the main topic for today. Of course, we're going to get into a slew of other topics. The Fed's balance sheet increased by $300 billion. This is going the opposite way. We're supposed to be going down in order to fight inflation. I will explain this for those of you beginners in a second, but can you guess what this money printing is? Yes, it is the Fed's new emergency bank lending program that it opened up to the banks in order to stop a contagion of bank collapses. So in this video, we will get into the Fed balance sheet and why is it increasing? Is this going to be inflationary? Is inflation going to come roaring back because of this? I'll get into the details of the Fed's new lending program. We'll talk about what are the requirements. Can the banks use the money and make money off of that money? Meaning, can they just borrow cheaply from the Fed and use that money in order to loan out more expensive loans to consumers and businesses? There's actually an extremely alarming yet solid track record of the bank actually taking advantage of the Fed. So we'll talk about this. All eyes on the next FOMC. Of course, we will be live streaming. That is going to be March 22nd at 2 p.m. Eastern time. And then we're going to talk about the state of the market. Is it time to buy stocks? If not, at what point or what things should we be looking at in order to determine whether it is time to buy stocks or whether this fear-ravaged environment is going to present us with opportunities. So I'm going to be giving you the inside scoop, a heads up at what am I looking at, when am I going to start buying stocks, what indicators need to fire off for me, and also how I'm trading this environment currently, because right now at the moment, we are really just leveraging our day trading capabilities. Without further ado, let's get right into it. All right, guys, before we get started, make sure you are following me on both Twitter and Instagram, where I post free daily trading and finance content. I post what I'm looking at. Sometimes I post trading setups. I post market updates, short market updates. I post tutorials. So follow me on both Twitter and Instagram for free content. All right, so the Fed's balance sheet rose by $300 billion. They printed an additional $300 billion. Now, obviously, they're not printing actual paper money. They are just keystroking this in and sending it to the different banks. Now, is this different than, an actual bailout? Is this different than what they were doing with quantitative easing, where they were buying treasuries off of the balance sheet? Yes and no. And also, it depends on who you talk to. Here's my perspective. The Fed is loaning out this money in their emergency bank lending program that they opened up to the banks in order to stop the contagion of bank failures, basically reassuring the banks and hopefully in turn reassuring depositors that, hey, there's an endless supply of money that we have that we're going to use in order to save the banks. The banks can borrow basically as much money as they want and can use the funds to stop themselves from actually going bust. Now, I have a real problem with this insofar as this incentivizes banks who have really behaved in a way that is irresponsible and negligent, right? Ignoring the fact that there is this huge interest rate risk on their bond portfolio because they basically bought bonds that decreased in value when the Fed started raising rates aggressively, as if they didn't know the Fed was going to raise rates aggressively. And so it incentivizes them in the future that, hey, if we actually act irresponsibly and we act for some of these banks, to be fair, they've acted really stupidly, there will always be the Fed or some sort of government entity there to backstop us. So I don't agree with it insofar as that, but let's dig into the details of this bank lending program. Here it is from the Fed's own website. The program is to provide liquidity to U.S. depository institutions. Each Federal Reserve Bank would make advances to eligible borrowers, taking as collateral certain types of securities. So long story short, they're not just going to be giving these banks money empty-handed. They're going to be asking for collateral. Now, that collateral is going to be in the form of treasuries mostly. So the Federal Reserve loans the money. The banks then give the Federal Reserve their treasuries. Now, here's the important part. The collateral valuation will be par value. So the problem with what went on with the banks mishandling their bond portfolio, how do I explain this? Let me explain this Khan Academy style in a second. So basically, the banks bought these treasuries, right? So say you bought these treasuries here, and let's just say that these treasuries were worth $10 billion, okay, an arbitrary number. Now, as interest rates have been going up at the fastest pace since the early 80s, what happens to you guys, if you guys are fans of this channel? In short, what happens to treasuries or what happens to bonds when interest rates go up? Well, the value goes down, right? Because new interest rates or new treasuries are issued at a higher interest rate. So old treasuries, if they are to hit the market, they can't be sold for the same amount as new treasuries. So they have to go down in value, right? So let's say that the bank's $10 billion portfolio now, bond portfolio, is now worth $8 billion. Well, if you look at the Fed's bank lending program, it says the collateral valuation will be par value. So it won't be based on this marked down $8 billion. They will count these treasuries that these banks give to the Fed in exchange for borrowed money. They will count it as 10 billion since that is the face value, not 8 billion, right? So in essence, banks are going to be able to borrow more than their assets are worth. Now, not only is obviously do they have to give up collateral, there is interest involved. So here's the interest. The rate for term advances will be 1 year overnight index swap rate plus 10 basis points. So if you look at the swap rates, it's basically going to be this. So for around 4.325% plus 10 basis points, which is 0.10, so about 4.425%. And lo and behold, banks already borrowed up to $300 billion, as you could see on the Fed's balance sheet. And this is way more than what was borrowed in 2008, which was $111 billion. So the real question is, will inflation be back? Well, for me, it really depends on how banks use this. If banks use this in order to, because again, they're borrowing still at a pretty cheap rate, only 10 basis points above the overnight lending rate. If they're borrowing at a pretty cheap rate, what's to stop the banks from using that money and lending that money out to customers, with a much higher rate for loans? So, right now, mortgages for 30-year, you're likely going to be paying close to 7%. If you want to buy a car, it's going to be something similar. If you want to open a business, it's going to be something similar. So if they're going to be borrowing at a cheap rate, what's to stop a bank from, taking the money from the Fed and lending that money out and essentially using the Fed's cheap money in order to make money? Now, you might be thinking to yourself, is this legal? Yes, this is legal because the Fed is not a legal entity. The Fed cannot enforce, they cannot tell the banks what to do with the money. We actually saw this in 2008. There's a really good documentary called The Age of Easy Money, which is available for free on YouTube, and I implore you guys to take a look at it. But I'm not going to, it's almost a 2-hour documentary, but there's a very specific part in here where in 2008, it talks about specifically a similar issue where the banks took advantage of the Fed's free money, but didn't use it for what the Fed wanted the banks to use it for, because the Fed cannot actually force the banks to do anything. This has to come from policy. This has to come from policymakers. So I will talk about that in a second, but let's take a listen here.
You were injecting money into the banks, more than $1 trillion worth at that point. And what were the banks doing with that money?
The Fed's idea was the banks would be taking that money and lending it effectively at lower interest rates. What the banks were doing instead was that they were just investing in the same bonds that the Fed was buying. They were taking that money and they were turning around and buying the same mortgage-backed securities and other bonds. Why? Because the Fed had made very clear that its goal was to drive up the price of financial assets. And so Wall Street turned around and thought, why would I go through the effort of making a mortgage when I can just press a button and buy, millions, if not billions dollars of bonds and ride that trade as the price of those assets are very consciously being inflated by the Fed.
So there you go. And I implore you guys to watch this. It's called Age of Easy Money. I will link to it in the description. It's a great documentary that just came out a few days ago and also talks about the current busts of banks such as Silicon Valley Bank and Signature Bank. So it's a very up-to-date documentary. But my point is, there can't be any enforcement done by the Fed on what these banks do with the money that the Fed gives them. So it can be inflationary. Is it inherently inflationary? No, it's not meant to be, but still it's adding assets to the Fed's balance sheet. And it's injecting the system with liquidity. Now you could say to yourself, well, they're actually taking collateral, for that money. They're not just giving out free money, and it's for a specified amount of time because the Fed's loan is just for a specified amount of time. But yes, check out when the Fed actually is going to leave this policy open until. It's from their own website. Advances can be requested under the program until at least March 11th, 2024. And I don't know if there's a maximum here that banks can borrow. I think they can borrow the amount up to the collateral that they can provide. So if they can provide the Fed with $100 billion in collateral, and again, the value of the collateral will be taken at par, even if that collateral actually declined in value due to the fact that interest rates have risen. That is a long ass window to keep this open. And I don't think that one can say whether one can definitively say now that, for sure it's not inflationary or for sure it is inflationary. I don't think we know. All I do know is that this is risky behavior in my standpoint, right? Let me know in the comment section if you agree with this. Would love to hear your take on why. Let's see what CNBC has to say about the Fed balance sheet, and then I will jump into the next topic.
To Steve Leisman, who has breaking news on the Fed. Steve.
Thank you, Morgan. We have the Fed's balance sheet for the week ending this past Wednesday, and it is up by $297 billion as a result of a couple failed banks, as a result of borrowing at the discount window. Borrowing at the discount window rose by $148.2 billion.
Steve, what kind of a position does this put the Fed in? It's been trying to reduce its balance sheet along with get rates higher, but things happen.
It does happen. I think the key here, John, and I do need to report this end of the story here. You are correct. The Fed has been trying to bring the balance sheet down, and this is a market increase in the size of the balance sheet. The question is how much of this money actually gets into the economy, in the sense, does it become the source of loans to the economy? And I don't think that's probably what's going to happen there. To the extent that banks borrow to liquefy themselves, it's probably not going to be something that's going to create lending into the economy. It may keep the existing lending that was going to happen in place, or keep it at the prior level. But I don't know that this is going to be actually inflationary. But it depends on what happens over time. Does the progress towards reducing the balance sheet continue after this?
So there you have it. I mean, basically what I said, there is no way to really tell whether this is going to be inflationary or not. I guess it depends on the extent that this runs. But if it runs until another year from now, and banks find that, hey, this is a source of easy, cheap money, then what is to stop them from just taking advantage of the Fed like they've done before? So you're probably saying to yourself, well, what other choices do we have? I mean, I'm not an expert specifically in banking regulation, but the way that I see it, right? Banks that fail or at risk of failure, they get put up for sale and bought out by bigger banks, just like UBS just bought out Credit Suisse. And our elected officials and politicians, or even the White House, the president, they should be able to put in emergency measures, right? Or executive orders or something that limit what the banks can use that money for. So if the bank wants to take advantage of the Fed's lending program, they have to, under threat of prosecution, they have to use that money for the purposes of, making sure that they are liquid, or, backstopping any sort of bank run, etc., as opposed to just being able to borrow the money and not really have to explain immediately why they need that money. Because I can easily see this balance sheet just go up into oblivion, especially if this is open for another year. The bank balance sheet is going to get to 9 trillion very quickly at this rate, right? Like, we went from 8.3 to 8.6 trillion over the course of a week. So how long would it take to go from 8.6 back to 9? It's just, when we're trying to fight inflation, there just has to be a better way than continuing to do this. Anyway, we really combine these two things in the segment. So all eyes will be on the next FOMC. Let's take a look at what the Fed Watch tool says. And as you guys know, the Fed Watch tool is really calculated by the numbers on the Fed Watch tool are calculated by how Fed funds futures are trading. And right now, 73.8% think that there will be a 25 basis point rate hike. I think so too, especially considering the fact that their balance sheet increased. They can't just not do nothing. They can't pause here. But I don't think they can go 50 because the Fed is going to use the excuse that, hey, our last inflation numbers showed that inflation was trending down once again, and there's really no reason to increase. The Fed doesn't have a record of going down in rate cuts, meaning we went from, 25 to 50 to 75 back to 25. They don't have a record of going from 25 back to 50 unless something extremely scary in the inflationary sense has reared its head. So if CPI came in higher than expected, much higher than expected, then the Fed might have done 50 basis points. I think it's going to be 25. And what's going to happen to the market? Well, funny enough, you guys are probably, well, some of you are not going to expect me saying this. I do think that the market can actually see a melt up here. I think that the market can actually see a rally, especially the fact that we have now, if you take a look at the put call ratios, there's an account called The Short Bear on Twitter. But if you take a look at the put call ratios, you will see that the put call ratios right now are at a record. Friday, there were 37.4 million puts opened. The second biggest was 33.6 million on September 23rd, 2022, before the stock market hit a bottom in October of 2022. So because easy money has entered the system once again, and the Fed looks like, they're going to do 25 basis points, and they might even pause very soon. And the reason that I think they're going to pause, for those of you that have followed this channel, is the fact that the 2-year Treasury is once again below the Fed funds rate. And this every time in previous times has signaled a pause. If you look at the blue line here, that's the Fed funds rate. So I do think the market can see a short-term rally because of the fact that the put call ratio is at a record level, and that we tend to see a lot of short squeezes when the put call ratio is that high. And then also easy money has entered the market. But I don't think bank failure after bank failure after bank failure is really going to be good for the economy overall. And I do think we are, playing with fire at the moment. Also, we did see the VIX spike above 30 for the first time last week, and it did this one time on Monday of last week. And finally, the VIX has hit 30 for the first time since October 2022. So, I'm looking for a huge spike in the VIX at some point in order to start buying stocks. Once the VIX is 35 or over, then I do think that we are, close to 35 or over, then I do think that we are in a position to start loading up on stocks again. Where will the S&P 500 be by that time? Well, again, this is a very hard thing to predict here. This is not, a general downtrending market like what we saw for most of 2022, where, we can really play the bounces off of this trend line here, especially once that we popped above it. And it looks like for now, we hit an epic bear market rally. It's very hard to predict this new trend once this trend was broken. So I'm not going to act like I know exactly what's going to happen when. I do think that we can see a short-term rally in the form of short squeezes. I do think that, depending on what happens, the situation is very fluid. Depending on what happens with the banks, the market could drop once again. And we could easily see these October lows if the system continues breaking under the pressure of these rate hikes. If the Fed pauses at some point soon, which I think they will do before the summer, I do think that will signify near the bottom. Wherever we are at that point, that will signify near the bottom of the market. And I will be looking once again at buying the 2-year Treasury note. You guys know that I've been loving this trade. The 2-year Treasury actually has had the best week performance of all time. For those of you that watch this channel, shout out to you if you took this trade. If you guys want access to all of our trades, as you guys know, we are day trading every single day, as well as sending out our weekly analysis on what we see in the stock market, where the stock market is going, when we're going to start buying things such as stocks, commodities such as oil, etc. If you guys want access to all of these trades, link is in the description below. Join the academy. I'll click the link to apply, and if you are accepted, you will be notified right away, very shortly thereafter, if you are accepted. So click that link below, join the academy. Let me know what you think of this. Do you think that this is inflationary? Do you think that the Fed is printing money? Do you agree with what the Fed is doing? What would you do differently if you disagree? Would love to hear from you. If you guys get anything out of this video, hit that thumbs up, hit that subscription bell, hit that subscribe button, click the notification bell. Stay safe out there, traders. Peace.